The three common indices of the U.S. stock markets are displayed in this time series chart: Dow Jones, S&P, and NASDAQ. Two statistics of common interest are index high and index low. Consider S&P 500. This chart zooms onto the index values over the last 4 years. Shown are 148 record highs of the episode, and also 64 index lows or bottoms, which are minima between two successive records. Not all record highs or lows are of interest. Many are simply day-to-day fluctuations with small gains or losses less than 1 or 2%, as can be seen in this zoomed-in chart for June to December 2021. If only, say, bottoms of more than 2% are selected, then there are only 4 data sets of interest: the bottoms and the record high before each bottom. A loss or a down episode is the time between two successive records, filled with green shade as shown. An index bottom is the lowest index value in a loss episode. A loss episode can also be plotted on a relative scale. The down value of the index is calculated relative to the preceding record. Hence, different loss episodes can be compared based on the relative magnitude. Over the history of the S&P 500 since 1957, there are 1,208 index records, out of 16,500 trading days, giving a probability of 7.3% to have a record. On the opposite, there are 522 index bottoms, giving a 3.2% chance of encountering an index deepest loss. Over its history, S&P 500 has 20 episodes with a loss of more than 10%, that is, a buying opportunity with a gain of 10% or more, if an investor has the divine foresight and patience to wait until the index recovers. The number of loss episodes, and its duration, obey the single-sided Laplace distribution, which will be discussed later. With the loss data, it is possible to let the current index curve travel backward in time to be compared with other losses as shown next. The S&P market behavior in summer 2022 can be benchmarked against the historical loss episodes. The time backward scan will slow down for episodes that have a bottom within a comparable magnitude with that of June 2022. There is a strong statistical relationship between the depth of a market loss and the time behavior, both the time it takes from a record to the bottom, and the recovery time from a bottom to the next record. What it suggests is that there is a certain empirical probability distribution of the time it takes for a market to recover from a bottom of a given magnitude. In other words, it will be highly unrealistic to expect, for example, the loss of June 2022 to recover by the end of September 2022. The superposition of the June 2022 loss curve onto other historic curves should serve as an illustrative benchmarking for this time statistical property. A random walk down Wall Street, to stochastic calculus, all are based on the assumption of truly Brownian stochastic processes of the stock market. This might be true for the short term, such as weeks, days, minutes, or even milliseconds of high-frequency trading, but not necessarily true for the long-term behavior. Analysis with classification algorithms such as neural network indicate the similarity of certain patterns as highly improbable, if due to purely random chance. Hence, benchmarking such as the scan is not like the old technical analysis, but can give a statistical assessment of the market pattern that is not purely Brownian random, but a stochastic function of the human investor socio-economic psychology and behavior. The above discussion is based on S&P index. The same general behavior is observed for Dow Jones and NASDAQ. Many component companies are common to the indices, although different sectors of the economy have different growth behavior. For example, as technology is the driver of today's economy, tech-laden NASDAQ naturally exhibits higher growth, higher volatility. But certain fundamental patterns that are functions of the human investor psychology and behavior are common to all market indices. The NASDAQ, being of high growth, also exhibits high volatility with record losses in its history. Most notable was the tech crash of 2001 that took almost 15 years to recover. The September 2022 loss is the largest in more than 10 years. For the Dow Jones, in spite of being more than twice longer than the NASDAQ, its number of loss episodes, 77, is only 50% higher than that of the NASDAQ, showing the latter's high volatility. It can be shown in another presentation that the three indices, with different growth rates and volatilities, obey the same textbook security market line of the old-fashioned capital asset pricing model, that is, high risk, high payoff. The 5% or more loss curves of all three indices are shown on the same scale. After the Great Depression, it was thought that it was a lesson learned unlikely to be replicated. However, the tech craze irrational exuberance of the 2000, plus the financial crisis of 2008 nearly replicated the situation. Although the difference this time, of course, was the Keynesian remedy of government bailout, that might have averted a worse mass unemployment, and overall business downturn. Lastly, the stock markets are certainly a part of the economy, and most of the loss episodes have to do with recessions, as evidenced in this chart. Every recession caused a significant market adjustment, but not necessarily vice versa. The markets can be overheated on their own, and a loss episode is often a correction.